Here's the real one.
Good morning, YouTube. Today is Tuesday,
We ain't
May
live.
7th.
It doesn't say live.
We're live, baby.
We're live, man.
I
No, it does.
I don't know what you're talking about. Get that computer updated. Must be
I
running.
don't know. I don't know.
Daddy Burko running a little behind schedule today.
Rough. This is fun.
Good morning, everyone. Well, Tom, how you doing today?
I'm doing excellent. It's another beautiful morning. I got to see a little bit of sun before it started raining today, so it's good.
Beautiful, beautiful. Anth, how are you?
Good. Good morning, fellas.
Hey, next time he tries to interrupt my opening, mute him, please.
I'm telling you, it wasn't live. Now it says live. It's in the corner, but it came in live a little late.
No,
It could have been worse. No, it could have been worse. He could have been like,
I right before we did go live, it could have been worse. Everybody knows.
Well, guys, we had a topsy-turvy week last week with interest rates. You know, we talked about the Fed meeting. They didn't do all that much. That didn't really affect rates all that much. And then as soon as we shut down on Friday, jobs report came out and the jobs number was bad. Bad. That means good for interest rates. Jobs number came way under, which meant we saw about a 0.25% drop in interest rates last week. Still higher than we want them, but maybe, the Fed needs the economy to do worse to lower their rates. So maybe this is indication that the jobs are starting to falter. Maybe we'll see a drop in rates to bring the economy back. But as of right now, June rate cut is out the window. I don't know if any rate cuts are happening in 2024. It's going to be all dependent on really this inflation number. But we're going to stand pat here for now. But I did want to update everyone that the jobs number did come in negative literally the second we shut down on Friday.
Yeah, no, appreciate the update. I'm going to stay out of the weeds on this one right now.
Well, we just have to get these, it's clear, guys. It is very clear. Rates in the 6s, buyers are still buying houses. Rates in the 7s, what do we hear instantly? Oh, now there's more inventory. Inventory is increasing. Why is that? It's not people are magically putting their houses on the market. The buyers are slowing down a little bit.
Yep.
And maybe with rates being higher longer, those boomers that have all that equity in their houses that won't sell because they're saying they have such a good interest rate, maybe it's like, okay, well, I got to retire. I got to downsize. I got to move at some point. I've now waited 2 or 3 years. At some point, you just got to bite the bullet and move on with life.
And I think it's going to start moving here soon. I mean, I'm thinking 3 to 5 years after the interest rates do increase, those people start getting sick of their house possibly and just not being able to live through it. I think this summer, a lot of people are going to start to realize this house isn't for me. So I'm hopeful that, we could even get down to 6.5 because you guys see the flurry of activity, even at 6.5. Rather than 7. So hopefully we can get down to that number, just come down a little bit more than where we are by the end of the summer. And this summer could be a little bit hotter than normal. On the flip side, it could be just stand pat because it is an election year and nobody's trying to move anything around. We could sit here at 7. The market is still moving at 7. People are still buying houses. So don't be afraid to put your market on or your house on the market and get it moving because there are still people buying houses if you do have your house price right.
I'm glad that our chatter followers have listened to us from the beginning. I know there were some other companies and loan officers, once rates started increasing, it was going to be just a couple months until rates come back down. And historically,
they're domestic partners with those rates now. They're not even dating them.
Historically, that's never been the case. Historically, when rates come up, they stay elevated for a few years. As we said from the beginning, rates go up a lot quicker than they come down. And we are seeing that to a T here in this cycle of the last couple years. You know, I mean, we even had Janet Yellen saying last year that inflation is transitory, or 2 years ago, whatever it may be, 3 years ago. And she was wrong. I mean, so this inflation, these higher rates, I think we saw sticking around for this time period, but everyone else, all those experts out there tried to tell you that, oh, no, that this was Russia's fault, or this is coming out of COVID's fault, or this is so-and-so's fault. And I think we're all pretty aware that if our government overspends, which I don't know who would disagree with that at this point, it's going to cause inflation. And that's what we're seeing. So we'll see if it comes down. But as of now, we're kind of hanging tight.
Our debt number's out of control. Out of control.
Our debt number is not even a real number at this point. How long until it's literally how long until it's literally not a number that we even know? What's after trillion?
Quadrillion? I don't even know.
I think we've made those. I think we made that number up as a kid after trillion.
Yeah, infinity. I mean, the thing is, it can't get any higher because there's no more government programs that be given. So I think we're good.
Well, moving on to our main topic today, we're going to get into closing costs. We're going to get into the biggest variable of your closing costs from your initial estimate to your final costs. And that's called an escrow account. The escrow account is built for a buyer to hold their property taxes and insurance. So when they come due every year, they're paid automatically. Most home buyers, unless you choose not to have an escrow account, and that's putting 20% down or more on a conventional loan, most home buyers have their property taxes and homeowners insurance paid for them. But Pennsylvania does taxes a little wonky. You always have to pay taxes a year ahead of time. So when we estimate your escrow at application, I think it's pretty customary for all of us to estimate 12 months at the beginning because, well, we just don't know what that escrow is going to be. You have to pay the seller back for what they paid already this year. So it could be ending up being 12 months. Anthony, you able to pull that up, or do I have to pull it up?
Oh, my bad, dude.
It's okay. So here we have, if you're ever looking at a loan estimate, everyone should get a loan estimate when they're applying for a mortgage. The loan estimate is the only document you can really compare apples to apples with. But in every single loan estimate, you'll see Section G. Section G is the initial escrow payment at closing. We always have 2 months of homeowners insurance. We always estimate 12 months of property taxes. Anthony, does that mean it's going to be a full 12 months at closing?
No.
Okay.
No, I mean, essentially. I mean, it's going to cover, that's a two-part, line there because it covers the starting of the escrow account so you don't have a shortage when they come due, but then it also pays back the seller for prorations. So like
what gets me is us at West Penn, right? We're trying to give real numbers to buyers. Okay, we don't know what it's going to be yet. We estimate 12. Most buyers, now real estate agents, you should know this because you're your buyer's eyes and ears. This can be estimated anything the loan officer wants at mortgage application, at pre-approval. If you want to put 1 month in here, you're allowed to put 1 month in here. And then some buyer will call me and say, Ryan, I'm going somewhere else because investor B is thousands of dollars less than you. It's not true. The escrow is going to be the same no matter what lender you use. It's all
right. How could they be thousands of dollars better when we only charge $1,000 to do the loan? Doesn't make any sense.
Math doesn't add up there. But again, I get it. Buyers are just looking at their bottom line. And that's not the smart thing to do because in the mortgage world, there's so many variables that you got to look into. And this is, again, the biggest variable. I could put $300 in here, or I could put $3,600 in here for this specific estimate. That could be a difference of $3,300 on a bottom line. It doesn't matter if it's 12 months or 1 month. When the tax collectors talk to the title company, they will confirm exactly how much taxes are needed for the escrow, how much the buyer needs to pay back the seller, and then that will be updated on the final closing disclosure. So real estate agents, pay attention to Section G. It's very, very, very important. If you see a very small number, especially in PA, where we're getting into the summer months, the school tax is the biggest tax. The school tax is usually collected around July, August, in that time frame. If the title company can't prove that the tax has been paid for this year, they're going to collect a whole year to be safe. Many times we see in the summer months a full 12 months of taxes needing to be collected for an escrow. Plain and simple. So what do we do at West Penn? We estimate 12 months to try to show our buyers a worst case scenario.
I think any loan closing in June should have that 12 months. I mean, because the 2 months skip start in August and 12 months coming up there due in August, the school taxes.
And I mean, I would feel awful if I show someone an estimate. They put an offer on a house. They're expecting my closing costs to be pretty accurate. And then their costs come in literally thousands of dollars higher because I just put 2 months in for an escrow. When as a mortgage professional, I'm not a salesperson, I'm a mortgage professional. I know that it's not going to be that. I think that's an awful way of doing business. I would never do business that way. And I'll continue to put 12 months in there to make sure we give worst case scenario.
I think I'm going to keep putting 12 in there. I feel like that's just a legal bait and switch that people do. Scummy move, 2 months, and go on from there.
When the loan estimate was created, they envisioned this being the greatest form ever. Most lenders won't give this form out because they don't want to show their real costs. But if you have 6 pieces of information, if you've been pre-approved with an address, mortgage law says you have to have a loan estimate. So get this form. It's the only way you can compare costs. I preach this every day. I don't know how many times I can say it more, but loan estimate, loan estimate, loan estimate. Anth, you got anything to finish up?
He's frozen like a
glacier. That's crazy. I thought he was just sitting still. Anth went frozen on us.
Maybe he died.
Holy, don't say that.
But look at him.
Oh, hey, let's talk. Hey, Anth, how you doing today, bro?
Yeah, look, he got a big chew in his left side, and he's good. He's ready to go.
I think maybe his daughter pulled the
Wi-Fi
on him.
He didn't want to do school from home today or something. Yeah. Who knows?
All right. Well, I think that's a great way to finish. I'll see you guys Friday. Tom, get some sleep.
Yeah, we're gonna figure this out.
I'll talk to you later.
Later.